Okay, so what I want to do today is jump into a few different sectors and what I believe are reasonable ranges in a bear market, bull market, just general points of entry for this dividend growth investor. Hey everyone, this is Ian. I'm back with another video about dividend growth investing. So today's video is another response to one of your subscriber questions. Thank you so much for having those. Please keep them coming in. The question today is, hey Ian, what does the PE ratio, price earnings ratio, mean to you and your strategy in dividend investing? So I invest for dividends and cash flow. I buy stocks that pay dividends, pay increasing streams of dividends over time, because I want to live off of my passive dividend income. And so when I analyze PE ratios, price earnings ratios, I analyze them from the perspective of a dividend growth investor. So I took some notes, as I always do. The first note is PE ratios are very industry specific. So every industry tends to carry different PE ratios, and I look at them by industry, and so I'm going to get into some specific industries later. Second note, PE ratios are very different by market. We're in a bull market right now, so the PE ratios tend to be higher. In a bear market, they tend to be lower. And so just right now, the PE ratios in general tend to be higher. So when I go into the industries later, I'm going to give a range. I'm going to give a range of acceptable PE ratios to me that I like. And the range really reflects the market. In a bear market, they could be as low, or on a value side, they could be as low as the bottom of the range. In a bull market, it could be as high as the top of the range, but I'm comfortable buying within that particular range for that particular industry. So we're going to get into that in a minute. But before we do, what is a PE ratio? PE ratio, quite simply, is the price of the stock divided by the earnings per share. And what it means to me is, if the earnings stay flat, there's no earnings growth, how many years do I need to hold this investment for it to earn enough money to pay for itself, meaning to pay for the price I'm paying for it? So let's take a simple example. Say there's a stock that costs $100 per share. Let's say it earns $10 per share. 100 divided by 10 equals 10. That's a PE of 10. Now okay, it's earning $10 a year. Let's say the earnings don't grow. Well, 10 times 10 over 10 years, very simple example, but it takes 10 years to earn enough money per share to pay for the purchase price. That's how I look at PE. So when PE is really low, it takes less years to pay for it. PE is really high, it takes more. And you see sometimes these crazy stories about, hey, this stock has a PE of 30 or 40. And the idea there is it could take as many as 30 or 40 years to pay for itself. In my opinion, that's usually not a good indication of a good entry point. And certainly some investors have had success with that in the tech arena, where earnings are growing really quickly, but that has never been my investment thesis. I have always attempted to buy stocks with reasonable PEs so that I have the margin of safety and the comfort that I'm getting them, one, at a value, and two, I'm getting them at a point where the earnings can end up paying for the share sooner or later. So there are two types of PEs. Both are a measure of value. At the end of the day, what a PE ratio is, it's a measure of how much value one is getting when they purchase a stock. The trailing 12 months PE is the one I look at. It looks at the price of the stock divided by the earnings from the last 12 months. A lot of investors also look at what's called a forward PE ratio. This is the price of the stock divided by what the earnings are expected to be in the next year. I don't like the forward PE ratio because I don't know what the earnings are going to be in the next year. Maybe the analysts think they have it figured out, and maybe they do. Certainly there are some bright analysts out there, but I only like to look at money in the bank. I look at PE ratios that are representative of the last trailing 12 months. But certainly everyone has their own style. I just like to model conservatively. And if you've been watching my channel for a while, you know that about me. You know that I am a conservative modeler when it comes to finances. Okay, so what I want to do today is jump into a few different sectors and what I believe are reasonable ranges in a bear market, bull market, just general points of entry for this dividend growth investor. So utilities, regulated utilities. I like to buy when the PE is between 8 and 14. 8 is going to be really low, 14 is going to be really high. For me, if the PE is above 14, I'm not going to buy most likely a utility stock at that point. It's just going to be too rich, too expensive for me. If it's below 8, it's probably indicative of something really weird going on. It's probably something potentially bad, some kind of issue specific to the company if it's below 8. With a consumer non-cyclical stock, so we're talking about household brands here, these are a little bit more expensive because these are the companies everyone wants. These are the blue chips. These are the companies that make all the products that everyone needs to live. These are the staples in my dividend portfolio. These are the companies that I love. PEs for those, I would typically purchase anywhere between 12 and 22. So 22 is going to be on the high end. If it gets much above 22, I like to wait for it to dip. I wait for the share price to come down. I wait for it to dip till I buy. Below 12 is not likely. It's just not likely unless there's some market catastrophe. But it could get down to maybe about 12 in a really bear market, or just if the stock is potentially on sale, there's something really weird that's happening with the stock. Now, one thing worth mentioning with my strategy is I own over 30 stocks. So the reason I like PE so much is I can look at each of the stocks, I can use PE, I can understand where the PE for that stock falls within my acceptable range for the sector the stock is in, and I can compare all of them. And then it gives me options. It gives me options when I am purchasing stock, and because I own a portfolio of over 30, I can dip into the ones that are on sale that have the best value right now. So PE is one of my bellwethers. Once a stock is in my portfolio, I've done all of the analysis. I know I love the stock. I know I want to add to the position. It's in my portfolio. It's in the portfolio forever. PE is a really easy way for me just to compare everything. I adjust it by industry. That's why I'm going through industry. But I can tell, hey, what's a value right now? What's on sale right now? Where do I want to put my dollars right now? So that's why I love PE for dividend growth investing and for my portfolio. So what's another sector? Industrials. Industrials, these are like these big B2B companies. They can sell anything from airplane parts to elevators to industrial parts. These companies, for me, PEs have always been acceptable to me between 12 and 16. That's where I buy them. And a lot of the time, I'm not very heavily weighted in industrials. I've usually bought them only when they're on sale around the 12 to 13 PE range. Sometimes they'll dip down to 11. So that's what I'm looking at for an industrial. Healthcare and pharmaceuticals, very similar to consumer non-cyclical. I'm looking between 12 and 22. Most of the time, they're in the high teens or low 20s. And that is a sector everyone loves because we know our population in the greater United States is aging. We know worldwide population is growing and eventually will age. We know everyone wants better health care. There's a bright future for these companies. There's a bright future also for consumer non-cyclical with the growing population, and I would say with the brand names. And so these are kind of premium stocks, premium blue chips. They're staples of the portfolio. And so they trade at higher PEs, and I'm willing to buy them at higher PEs. They're more secure. They're not cyclical. And so they do well in good markets, bad markets. And so that's why the PE range it's a little wider, but it also typically skews higher for me on those types of stocks. What else? Restaurants. Restaurants are an interesting one. I'll look anywhere between 12 and 22 again. When I look at restaurants, I'm looking at world-class companies. I'm talking about brand names like Starbucks, for example. Disclosure, I own that one. I'm long on Starbucks. I'm willing to pay anywhere between 12 and 22 for a brand name, world-class, global brand name restaurant. Again, this is non-cyclical. Good market, bad market, everyone needs their coffee. Everyone, quite frankly, needs a break. They need to get out of the office and take some time for themselves during the day. That's what Starbucks is to me. That's why the range skews a little bit higher. But in a bad market, one may be able to get those shares as low as a PE of 12, and that's where I would be all over them. But in a good market, I'm willing to pay up to 22 for something like a Starbucks. Finance and banks, these skew lower. I will buy a bank stock between 10 and 14 PE. And the reason for that is there's going to be a lot of disruption happening in finance. There already is. Banks are an interesting beast. Like utilities, they tend to trade at lower PEs, so it's an industry level thing. And just for me, for that level of comfort, honestly, with banks, I typically don't even go as high as 14. I'll typically only buy them when they're in the lower end of the range, around 10. That's just been my strategy. Energy sector. Energy sector, I'll go between maybe 10 and 18. Energy is another riskier sector. This is a cyclical sector. I typically wait for a cyclical down market and I buy towards the lower PEs. Now, challenge with energy is, like right now, most of those stocks have a really high PE. That said, this is one where maybe one needs a little bit more of a broader horizon than just the PE ratio. There's a lot going on there. There's a cyclical price of oil. There is the fact that oil right now is at a lower valuation. It may trend up over time. Should someone be a little more forward-looking in their PE for energy companies? Maybe, maybe not. I have always played it pretty conservative on the energy sector. That being said, my range, I would say that if there's one sector where I've broken the rules based on forward-looking projections, it would probably be the energy sector. For beginning investors whose portfolio is just getting started out, at least in my case, I only added the energy sector later. It's not a sector that I'm a huge fan of for the long term, but there are some really big dividend yields there, and so it's enticing to add a little bit of exposure to the energy sector for a more mature dividend growth portfolio. What else? Technology. This is my unique spin. Most tech companies have sky-high PEs. I only like tech companies that have really good dividends, lower PEs, so I buy tech companies between 10 and 16 PE. Typically, I only buy tech companies when they're on the lower end of that range. So I buy the big blue chip tech companies that I think will be around forever. And I get in at a very attractive PE because there's more risk with technology, there's more disruption that can happen, there's more change. And I quite frankly, kind of like energy, I don't overweight in tech. I keep my weighting pretty darn low. And so to mitigate risk, I try to buy tech companies at a lower PE, ones that pay dividends. Retail, anywhere between 10 and 14. This is an industry facing disruption. And so I do own retail in my portfolio. Retail, 10 and 14 works for me. I like to get those at the lower PEs. Paying anything higher than that, I could not rationalize it. Absolutely could not rationalize it in my portfolio. And real estate investment trusts. These actually are an exception to the rule. One does not want to look at PE for real estate investment trusts. One wants to look at funds from operations or adjusted funds from operations. I will cover that in a completely separate video, but I just want to add the note here that if one is comparing PE ratios and looking at industries, one probably wants to stay away from the PE ratio for real estate investment trusts. So today's video, just a fun one on PE ratios, why I use PE ratios, what they're about, how I look at them by industry, and how, more than anything, I've got some general ranges that are acceptable to me by industry, and I use those to take the emotion out of investing. Now that I've got my ranges, all I have to do is sit back and wait. I just say, hey, I got 30 stocks, I'm going to wait. When one of them gets in one of these ranges, or maybe many of them are in the range, which one's the lowest one, which one's the best value, it helps me just choose. It helps me choose where to deploy my next dollar, because I'm always buying. I'm always averaging into the stock market, both in good times and bear market times as well, because for me to reach my goal of having a massive amount of passive income to cover all of my living expenses, which are quite high here in the greater Bay Area, I can't just buy once in a while. I have to always buy. I'm always buying. And so bull market, bear market, I'm buying, I'm committed, I'm holding the stocks forever. And so PE ratio, once something's in my portfolio, is just truly valuable for me making non-emotional, unbiased, data-driven decisions. Thank you for that question. That was a subscriber question. If you guys have more questions, please keep them coming. These fuel the content on my channel. I greatly appreciate them. If you enjoyed the video today, you would really make my day if you gave me a like, a comment, a subscription. I watch all of this very closely on YouTube, and every little like means the world to me. It makes me very happy. So thank you. Thank you so much for your support. It means the world to me. And there are great things ahead for my channel. Stay tuned. There's so much on the way, so much investment I am making in taking this channel to the next level, as I had promised to everyone out there when I surpassed 1,000 subscribers, and I did that, and I'm making those investments, so just stay tuned. There's some good stuff on the way. I am not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. My name is Ian Lopuck. This is ppcian.com. I will see you in the next dividend investing video.